rates doomed. Our mortgage rates doomed, y'all. At the end of 2023, we were promised that in 2024, interest rates would go down. So we were actually promised possibly 3 interest rate deductions. That has not happened. What are happening? Are rates doomed for the rest of this year? Before you know it, they actually might be going up a little. The Fed hasn't discounted the fact that they might, if they think that we need to, actually increase interest rates. That's right. You heard me. Are they potentially going to go up? So what we're going to talk about today in this live, we're going to talk about what the Fed recently said on May 1. And we're going to answer the big question, like, what does that mean for you? Like, what does that mean for homeowners? So thanks, guys, for joining us. We're streaming on all platforms today. I can see you on Instagram. I can see you on LinkedIn. I can see you on YouTube. I can see you on Facebook. So we are going to be going through lots of details today. Hey, Fernando Hernandez, my husband has joined. Hey, Fernando. We see everybody here today. So this is going to be interactive. So I want to hear your questions. I can see your questions. I'm going to do my best to answer them as they come, because this is really important stuff, y'all. Like this is like our lives. Interest rates, car rates are affected, mortgage rates are affected, all these little things. So I'm Jen Hernandez. I've been, Loan with Jen on all the platforms. I've been doing loans for 28 years now, actually 28 and a half. I've closed thousands of loans. I've helped thousands of people not only purchase homes, but also refinance. So I can talk to you about both of those things. We're going to go over those things today. And we're going to also we're talking to you. You're really in 3 different groups, y'all. You're either a homeowner currently, and you are like, there is no way in heck that I am letting go of my 3% interest rate. Or you have to move because death, divorce, diamonds, diapers, that's what they say, the 5 Ds, downsize. Or you're a renter and you're like, I am sick of wasting money on rent. I want to buy into this wealth accumulation that is a real thing, by the way. Real estate's like the best overall long-term wealth accumulator. And you can't, because you can't afford it. It's just, things are just too high. So we're going to go over that today. And we're going to talk about why this is all happening. Okay. Hey, Minka. Minka just joined us. See you there. I see you guys. Thank you. Thank you. Thank you. Remember to ask me some questions so I know what y'all are thinking. Okay. So May 1st, the Federal Reserve meets 8 times a year. They meet about every 6 weeks. So May 1st, they were meeting. We knew pretty much by this time, we've been through 4 months now of 2024. We pretty much knew that they were not going to do anything with rates. Now, there was always a chance that they could raise it, but they came out and they said, hey, we're leaving things where they are. Things are not going like we expect that they're going because inflation is too hot. Everybody's spending way too much money. The inflation numbers are going the opposite direction of where they're supposed to go. What that means is we're spending too much money, y'all. That's what we're doing. And so because we're spending too much money, the Fed is not doing anything. So inflation, what exactly does that mean? Inflation is the rate at which goods and services increase in value. So I'm going to pop a chart up on the screen. Those of you on Instagram, unfortunately, are not going to be able to see this, but inflation rates, as you can see, they were like peaking in 2021. They were up to like 7%. It was unbelievable. And the Fed wants it at 2%. They, 2.5%, maybe 3 is kind of okay, but it's still a little too high. So what that means is they don't want you and I to be paying $10 a gallon for milk, like literally. Like, I know we're not paying that now, but it seems like it. That's why they're doing this, okay? So inflation. Back in December, we were like having a party. Remember when you saw on the news, rates are down, lower, like rates went down in one day, like 0.5%. It was just the best thing ever. And the mortgage rates. And over time, the last few months, really March and April, these economic indicators have come out, okay? Economic indicators are how we gut check what is going on. What's going on with the economy? How are we spending money? It's the government's way of, or the economy's way of portraying to us like, hey, what's going on? And that's how the Fed makes their decisions. So back in December, inflation was 3%. They were like, hey, this is okay. I think, it's come down from 7 in 2021. We think it's time to start easing and give everybody a break. Like Chairman Powell actually even said, everybody needs a break. He actually said that. So inflation is going up. It's now 3.5% as of the most recent numbers from April. That's too much, y'all. It's going in the wrong direction. So what that means is that they don't know when they're going to be decreasing. They don't know. Actually, so on May 1st, we're going to actually put in notes. When you're watching this later, you can refer. We'll put the actually full recording in the notes and the description of what the Fed, it was like a 19-minute meeting. Okay, you're welcome to watch the whole thing, but I'm going to give you the shortcuts right now. Basically, they said the economy's going in the wrong direction. The economy's still too hot. It would be irresponsible if we lowered rates right now, because that's going to put pressure on inflation even more, because people are going to go grab debt. They're going to say, oh my God, rates are low. We're going to go ahead and get the house now because our payment is lower. We're going to go ahead and get the car because our car payment's lower. We're going to go ahead and charge more on credit card debt because our credit card is going down. All of those rates go down when the Fed talks about what they're going to do. Okay. So the Center for, let's see, I think we've got on the screen projections. We don't have projections yet, Jen. I got my friend Jen in the background and she's helping me with these slides. Okay. So again, sorry on Instagram, you're not able to see these. But the Center for Macroeconomic Data, the Federal Reserve Bank of New York, says that debt is at an all-time high $17.2 trillion. Y'all, that is just way, way too much. We are spending way too much money. Okay. It's crazy time. So what is the Federal Reserve anyway? Actually, before I dive into talking to these three segments of people, okay, I wanted to talk to you about what exactly is the Federal Reserve. The Federal Reserve was created back in 1913, and they are to keep us clean. They're to keep us on track. They're meant to help the United States make good economic decisions. Okay. And they're not owned by the government. They're not controlled by the government. However, the Federal Reserve is at the mercy of the government, kind of, because they're appointed every 4 years. There's a new federal chairman that is appointed. And so the appointed chairman by the President of the United States, and then the Congress affirms them. And the chair, the board of directors is 7 people. And then there's, sorry guys, I'm looking at my notes at the same time and all these things are going on. So I'm like, where am I looking? This is fun. So there's 12 Federal Reserve banks underneath all over the country. So I've got that on the screen. Those of you on Instagram can't see. It's Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Kansas City, Minneapolis, Dallas, San Francisco. So these are like sectors and regions, and all those regions take care of, in those states that they govern, really going deep on helping the people in that economy. So what they do, they're the watchdog. They're making sure we don't do stupid stuff. Okay, that's exactly what they are and who they are. Okay, so I actually have a question. So we're going to, K-Mac, thanks for asking the question. Could it be that we're spending too much money right now because things cost more? Yes. You are exactly right. That's an amazing point. And you're right. That's why they're trying to stop us from spending money. That's why the Fed goes in and says, hey, that's why they raised rates, by the way. The federal funds rate used to be 0 many, many, many years ago. And they kept raising it so that it would help people not spend as much money, because you're going to think twice if milk is double what it was a year ago, right? Like you're going to be like, okay, wait, I mean, obviously we have to drink milk, right? But you start to find alternatives. You start to drink less. You start to do, different things and make different decisions. That's what the purpose is of raising the rates. But K-Mac, you're exactly right. That's why we're spending more money, because things cost more. And guess what people are doing? They're putting on credit cards. I totally get that they're doing that, because where else are we going to put it, right? So I wanted to explain first what the Federal Reserve is, because you're probably like, who are these people that have our whole livelihood in their hands? Like who are they? So they meet 8 times a year, and 8 times a year they announce this policy. Now, the federal funds rate is not the mortgage rate. It's not the credit card rate. It is the rate which banks overnight borrow short-term money to cover things that you and I are taking out of the accounts or putting on credit. That it's the federal overnight funds rate is what it is. However, the rest of the world, like Wall Street and companies, follow and are influenced by what the Fed is doing. So the Fed, again, not controlled by the government, they make this announcement, and they say they just like control our lives with what the rate is and is not doing. So on May 1, at the May 1st meeting, they came out and said, hey, we're not going to raise the rates, because it's not the time to do that. The inflation, the country is still too hot, so we're not doing anything. And that caused Wall Street to freak out. They'd already freaked out a couple of weeks before, so the mortgage rates started to go up really 3 weeks ago. We've seen like a 0.5% or more jump in a 2-week period because of those comments and because of the release of data about inflation. So we pretty much knew, okay, there's no way in May, no way that they're going to lower rates. And now the June meeting, there's probably like a 1% chance. So the rest of the meetings are June, July, August, September, and November. So we have 5 more. At the end of last year, they said, hey, 3 is what we think we're going to do. I don't know, y'all. I don't know if they're going to do that. Nobody knows, right? Nobody. We can only go by the words of what Federal Chairman Powell is saying. And right now, it is not looking very good. There's actually some people, and I want to know what you think. Do you think that it may just be flat for the rest of the year and nothing is going to happen? That could be true, y'all. That actually could happen. They don't have to lower it. Now, I know what a lot of you are thinking. What about the election? The election year usually is a time when they want the economy to be super good, because they want people to feel good about the current president in office. Like this is basic logic, okay? So it's anybody's guess. And the Fed is going to be watching. What they said in their comments when you watch that 19-minute video is, we're watching things and we don't know where things are going to go. He actually said, I don't know. There was a question from the crowd, from a news reporter, and said, do you think we're going to have 3? He did not show his cards. He's like, I don't have any clue. All I can tell you is that right now it's not going anywhere. So what that means is we're at 3.5% inflation. Rates are where they are. Mortgages are somewhere between 7 and 8%, depending on your credit score, depending on how much money you're putting down. It just is the way that it is. So what are the projections? I'm going to put something on the screen about what are the interest rate projections actually. And then we're going to start talking to those 3 groups of people Do you rent currently? Are you a current homeowner? We're going to go through that right now. So the interest rates are projected over the next several quarters into 2025 to be in the sixes. Now, if you saw this data a few months ago, we actually thought that we were going to see something with a 5 in it. Well, those projections are now altered and they've changed. So I know what you're thinking, y'all. You're thinking like, okay, Jennifer, this is crazy. There's no way that I can buy a house right now with these rates. They're just super, super crazy. Now, nobody cares that the 50-year average of rates were still in good shape. That doesn't help you today. It doesn't help you afford a house to get into that wealth building that is out there. That's the American dream, right? This does not help you. So what does this mean? So I'm going to give you some more information. And my goal, by the way, I hope you keep following me. I've got lots of videos on YouTube. Actually, YouTube, I have over 600 videos that you can watch anytime, all about real facts, no BS. I bring you topics like this so that you can understand what's going on so that you can make the best decision for yourself. And let me be clear. There are some of you that just need to wait. Some of you you can't do it because your paycheck, like when I look at an application, I actually did a couple this week, I saw that their take-home pay in a 2-week period, so on the 1st and the 15th, their take-home was $1,800 and their payment would have been $2,100. And this was a single earning, this was a single mom. How is she going to do that if she can't get ahead because she's got 3 kids and $1,800 a month is coming in? She doesn't have another income to help her with that. So she's now going to have to dip into that next paycheck or, depending on how she has her savings, right? She's not saving any money. So she's paycheck to paycheck, which is a lot of Americans possibly watching this. You have to wait. Now, I do want to show you there is some hope in the future, so that we're going to be showing you some great slides here that show actually the mortgage payments and what even the smallest decrease is going to do. So hang on with me, okay? And then we're going to have some bonus rounds at the end where I'm going to talk about credit, whether you're buying now or waiting. We've got some special bonuses about credit that I'm going to give you, so stay with me. Hey, Tara, thanks so much for joining. I appreciate it. Thanks, y'all, for hanging in there, and all of you on Instagram. Thank you so much. Okay, group number 1. So I've got 3 groups I'm talking to today. Group number 1 is that you rent. You rent, you're sick of paying a landlord money that is going nowhere. Nowhere. And you want to start building wealth. Group number 2 is you're a homeowner and you have a 3 to 4% interest rate. And you're like, Jennifer, you are cray-cray, girl. There is no way that I'm buying a house and doubling my mortgage rate. Okay? 80%, did you know that 80% of Americans have an interest rate that are homeowners, have an interest rate below 5%? That is a real fact. The third group that I'm talking to is that you're also a homeowner, but you have to move. They call them 5 Ds of real estate: divorce, death, downsizing, diapers, and diamonds. I thought that was super catchy. So you have to move. In fact, I just had a call from a past client. We got him like 2.875 a few years ago. He's like, Jennifer, I have to move. We have 4 kids now. They've been very busy. We have 4 kids under the age of 5, and we live in that 3-bedroom bungalow, 1,200 square feet that you helped me finance 3 years ago. I'm going crazy. There's no room. There's crap everywhere. There's toys everywhere. There's diapers everywhere. There's children everywhere. Like, I cannot do this. We have to move. He doesn't care what his rate is. Now, we're going to be talking to those of you that have to move. I've got some things for you to consider as you're deciding, hey, what's the best decision for me? Okay. So again, thanks for hanging in there with us. We're going to get right into The renters, that's group one. So we're going to go back to group one. You're sick of wasting money on rent. Here's what I want to implore you to do. Buy now before things appreciate. Imagine all these homeowners that I talked about before, the single mom with the $1,800 a month paycheck. How can she do a $2,100 a month payment? Now, this is in Texas. Those of you around the country, I know you're shooting darts at me. Like, where can I find even a $2,100 payment? Okay, you have to just make this make sense in the market that you're in. So the renters out there are like, hey, like check out what I'm putting on the screen. This is, let's see. Sorry, I'm trying to blow this up. Rents are high. Like average rents are, what is that? For a 2-bedroom is $1,800. Now again, this depends on where you live, y'all. Don't freak out on me. Depending on where you live, average rent's $1,800. Now some areas are more, some areas are less, right? Well, the average mortgage monthly payment is maybe $200 higher than that. So depending on what market you're in, where average rents are, you could get into a mortgage for $200 to $300 higher than that. Now, of course, that depends on where you live. I get it. There's lots of disclaimers to that. Okay, I super know that. But you also get some extra mortgage income tax deduction. And don't forget that your house behind the scenes is appreciating. It's like a silent savings plan behind the scenes that when you go to top grade and move to a bigger house 7 years from now, when you've got the 4 kids like my client and you're busting from the seams, you're going to have all this appreciation that is accumulated. So we're going to go over some appreciation here to show you what that means. Like, what exactly is appreciation? Appreciation is the increase of something higher. So you're here, and then you go here. It's appreciating. That's what that means. So appreciation over time is a real thing, and that's why real estate is one of the best investments, I believe, and others believe, of all time. So you can get into something and you can have it appreciate while you're just living and paying something similar to a rent payment, maybe a little bit higher, yes, but think of it as a forced savings plan, okay? Hang on, I'm moving my, sorry, I keep moving my camera around over here. So, sorry, y'all, I keep doing my camera and I'm trying to see what I'm doing on the screen. It's Saturday morning. Let's see where we are here. Renters, okay. So, projected price increase. We're going to do an example. Let's see. What are we going to put on here, Jenny? We're going to put, what are we going to put on the screen? We're in the renter group. Projected price increase. Jen, why don't you show me the slide so I know which one we're gonna do there? The one about the appreciation? I can't see it. Oh, okay. So let's just say that you are in a $400,000 house. Let's just say you buy a $400,000 house, and over 5 years, your appreciation is going to go up to probably at least minimum 80,000 over to 480 over 5 years time. Okay. That's $80,000 in 5 years that you didn't have if you were renting. You wouldn't have that additional money. Okay. So that's what appreciation is. That's what that means. Okay. Now, 18 to 24 months from now, yeah, you're in the rates. Oh my God, they're 7.5%. Jennifer, this is just so crazy. Well, okay, but it depends how you look at it, because behind the scenes, you're having this appreciation. And remember, when rates do come down, all those people that were waiting because they had to, because they couldn't afford it, they're going to come out of the wall like ants, and they're going to be gobbling up the property. That's what they're going to be doing. They're going to be gobbling it up, and they're going to be competing against houses, and the prices are going to push up. That's going to be more inflation. Will we see 7% again? I really don't know, y'all. I don't know. All I can tell you is that prices will increase when you've got more demand than you have supply. That is going to happen. Okay. So you renters out there, if you can afford the payment, even though it might be like, I can afford it, but I really don't want to, just think about it. Think about appreciation and how you can also refinance in a few years. Now, a lot of companies, including ours, I work for Legacy Mutual Mortgage here in Texas. We lend in 38 states all over the US. We are giving clients a refi certificate, meaning, hey, we'll waive our lender fees at the time of a refinance. It just helps making refinance quicker. And what refinance is a refinance is just redoing your mortgage. You're just starting over. Okay. Yes, does it mean I'm going to another 30 year? Like, let's say that's 3 years from now. I've only got 27 years left, but Jen, you're putting me on another 30 year. Calm down. You can do a 25, you can do a 20. Some people go to a 15. So, that doesn't matter. That's just mechanics, and you can always pay extra. That's not a big deal. The point is that your rate will be lower. Okay. So let's talk about those mortgage payments. Okay. So what does, Jenny, I don't think I see anything on the slide here. Let me just see. Let's see if we can talk about mortgage payments here really quick. Oh, we have a question. Hey, Frank. Frankspiration. Thanks for watching. Can I pay my escrow in advance? My mortgage has hiked due to new escrow. Oh, yeah. You can pay your escrow in advance. In fact, I recommend that. So, but you have to have savings, right? So let's say your escrow shortage, I don't know, Frank, what it is. Maybe it's $3,000. You can pay that money in one chunk on your mortgage payment. Or not to your mortgage payment, to your mortgage balance. You can pay it to escrow, the $3,000, and then call the lender and they will redo your mortgage. Okay. So that's a great question. And you can just DM me on the side if I can help you with that. So Frank had a question about escrow. Escrow is where you have tax and insurance bundled in the mortgage. So Frank had an increase. So thanks for that question. Okay. Let's go to mortgage payments. Mortgage payments are, so on the screen, we've got to the far right, Jen, I'm having a hard time seeing these slides, but to the, let's see, Jenny, I don't even know if it's showing. I think it looks like the screen is black, Jen, in StreamYard. I don't know that I'm seeing anything. Hey, Krista, thanks for commenting. I really appreciate you. So mortgage interest rates, someone said to refresh. Oh, I need to refresh. Okay. Hey, guys, I'm refreshing. Here we go. On the far right of the graph. Okay, I know those of you online and those of you on Instagram can't see, but I've got a chart. And $450,000, your payment, if your interest rate was 8%. Some of my clients right now are getting 8% in the last couple of weeks, y'all. Some are getting lower, but let's just say it's 8%. Your principal and interest is $3,300 a month. If the rates go down 2% to 6%, which will happen in the future, we just don't know when, okay? That's, your payment goes down like $600 to almost $2,700. That's a big savings. I better believe you are going to definitely be refinancing at that time, okay? I don't even have to tell you that that's what you're going to be doing. So that's what refinancing means, and that's what these payments are going to do. Now, I know what you're saying. You're saying, oh, Jen, it's so easy for you to say. These rates, they're so high. Absolutely, they are. I know it because I got an adjustable rate mortgage. Let's just talk about adjustable really quick, y'all. I got an adjustable rate mortgage back 8 years ago. And in my head, adjustable means your rate is fixed for a little bit. My rate was 3.125, super excited. And I thought in my head that it was 10 years. So my husband is watching us right now. He's probably passing out in his chair because he passed out when I told him. Our rate went up from 3.1 to 5.1 because Jennifer went to go refi, but the rates were high. The rates were high last year. My rate adjusted in October. So I'm with you. My interest rate or my payment went up like 20%. It is not fun. I've accommodated because I can't really refi because the rates will be even higher than my 5.1 that I have now on my adjustable. But what I'm saying is I'm there with you. Yes, payments are higher, rates are higher, but just remember, they're not going to be this way forever. So those renters out there, I hear you. Appreciation is what you're missing out on, and it's a real thing. And those of you that can't because you just cannot afford the payments, I hear you as well. We're going to actually have this bonus round that I promised you here in the not so distant future about how to get your credit in the very best place so that when you do buy, everything is going to be super beautiful on that interest rate. Okay. So now group number 2, we're going to talk about group number 2. Thanks for hanging in there with us, y'all. This is about homeowners that are current homeowners. You have 3 to 4% interest. You're like, Jen, you're cray cray if I'm gonna do this. Well, let me remind you, if you bought in the last few years and you're at the 3 to 4%, I want to remind you the gift of COVID. The gift of COVID is, which wasn't supposed to happen, is that appreciation. You can see we're putting a graph. Those of you on Instagram, I'm showing a graph that shows, average appreciation in most years, like back in the early, 2015, 2016, was 4, 5, 6%, 18, almost 19% in 2021. Now, in some places, it was even higher. So to be an average of 18%, you have to have some higher and some lower. So take it with a grain of salt. This was in the United States. This was not supposed to happen. It was not. And so you are lucky. And we were all just the benefactor of these high appreciations. So you've got equity in your home. So I'm putting another graph up, y'all. Equity rich homes. People are at an all-time high with equity. There's like 47, 48% of the people right now in the US that have half of their home in equity, meaning that let's say their house is worth $500,000, their loan is $250,000. Unless, of course, you've already taken out a home equity loan against that to help pay bills and stuff. Some people have. But there's a lot of equity out there that's just sitting there. It's not doing anything. It's not working for you. It's doing nothing. So my point here is, remember I said a little bit ago that credit card debt is at an all-time high? What if you are one of those people and you're sitting on a ton of equity? You've been trying to make ends meet with all these higher prices of goods. K-Mac said it a little bit before. Aren't we paying more in life because things cost more? Yes, you are. And credit card debt is a way that a lot of people are unfortunately paying for that because they have no other choice. So I've put another graph up on the screen at the end. This is kind of the end of 2023. They did some data, and the average household was up debt overall is 5% higher on credit cards. Okay. Remember that 17 trillion nationwide that we talked about? That's like a real thing. So you're a homeowner, you have 3 to 4% interest. You might be one of the people that has 50% equity in your home. What if you cashed in on that appreciation? You can do one of two things. You can say, okay, I'm going to sell, because right now it's a seller's market in a lot of places where things are moving quicker. They're still under 6 months. Anything under 6 months inventory is a seller's market. Okay. There are more buyers that want to buy, believe it or not, than there is inventory, because you sellers that have 3 to 4%, you're staying in your home. That's why there's not a lot of inventory. Okay. So could you imagine sell your house, have all this equity that's built up? Remember the gift of COVID. You're not supposed to have all this equity, but you do. Take that money, pay off high credit card interest. That's 20 something percent. Pay off your 401k loan that you've done. Just, you could even put the money in the market. You could put it in E-Trade and invest it. You could fund your kids' 529 accounts. The best thing I did years ago, Fernando and I, it was about 14 years ago now, we had an event that got us a big chunk of money at that time. The best thing we did is we fully funded our kids' 529. And I'm here to tell you, I'm not giving you tax advice. I'm not a financial planner, but I personally was able to put in a 1-year period like $80K for each of my kids away. And now my first one is about to go to college, and I have 4 years of college money set aside because I took that equity at that time for that event that I had, and I socked it away and I didn't touch it, and it's grown in the market. So again, this is not tax advice, y'all. This is just my personal experience. 28 years as a lender, a human, another fellow human with kids and bills and college. I'm so glad that I took that money and put it away. So imagine you have equity. Imagine you did something like that and put it in a financial instrument that can be there when your kids grow up. What about that? So when your money is sitting in your house, it's not doing anything. So if you're like, no, there's no way, I'm not going to sell, well, then take out a home equity loan. DM me about a refi. I'm happy to talk to you about that. You can get the equity out of your home up to a certain percent, or you could sell it and you could go get out of the house that you're busting out of the seams at. With my client, John, he's like, Jennifer, I have to move, girl. This cannot happen. 4 kids, 1,200 square feet. So take that money, pay off some debt, take some of it, put down what you need to on the new place to get your payment where you want it or where you can survive for a little bit till you can refi. And then put the rest of it in an instrument that you can save money for college kids and all that kind of stuff. So again, just a thought, right? This is not financial advice, formal. This is just thoughts on a live stream. Now, what you could also do, you're the homeowner that has 3 to 4%. Okay. What you could also do is we've seen clients where they rent their house. So I actually talked to couple people this week. One guy, his payment is $2,100 a month, and he's got like a 3% interest rate, and he is going to rent it out, and he's going to a new loan. He's buying a house. Yeah, his payment's a little higher, and he's just putting down low. He's putting down 5%. You can put 5% down on that next house. You don't have to put 20% down. He's doing 5% down, and his rent is $3,400 a month. Y'all, there's a huge, between $2,100 payment and $3,400, that's $1,300. Now that's an extreme example. It's not always so great, but he's like excited. He's like, $1,300. Okay, let's just say of the $1,300, I set aside $500, which is smart. I put $500 a month in a savings account because I'm going to have repairs, and I'm going to have to replace the dishwasher. We had to replace the dishwasher on our rental house last month. We have a rental house, and we had to, the dishwasher broke and something else broke, and lotta $500 later, right? So put that money aside, but he's still up $800. Well, guess what? That's going to help him absorb the payment shock of maybe having temporarily a higher interest rate for a period of time until he can refinance. So that's group number 2. Okay. So again, you can rent that house, take that extra money because rents are at a healthy point right now, and you can use that to pay the next payment, or you can use it to pay off debt. Use that equity that you've got built up, y'all, and pay off debt. And you can still make a down payment. Remember, only 5% on the next house if you want, or you could do 20. Absolutely. You could absolutely do that. Now I'm going to talk to group number 3, and then you want to hang in there with me, y'all. I know this is going on for a little bit of time, but then we're going to talk about credit. Whether you're buying now or you're buying a year from now, we need to know about credit. So that's going to be our bonus round that's coming up. So group number 3, you must move. You're the Johns with the kids and the 1,200 square feet, and it is inevitable that you are going to move. Again, the 5 Ds: death, divorce, diamonds. You getting married, downsizing, diapers, you're having more kids like John. I hear you. I hear you. And the temptation to stay put is real, but guess what? You have to, because we had a lady just this last week. She is getting divorced. She has to move. She cannot live there anymore with her ex-spouse. She's got to move, right? So I want to remind you, rates will eventually go down. There's also some ways. There's something called a temporary buy down where we can use a seller credit to put towards your interest rate to buy the rate down a little bit. However, I don't want to talk a lot about that because we're not seeing it happen a ton, because there's less sellers than buyers, which means sellers are kind of like, hey, if I've got 3 offers on a home, I'm going to take the best one. And I don't want to pay a bunch of closing costs. So that's kind of hard. I don't want to guarantee you that you can do that, but it's certainly something potentially that you might be able to do. Okay. So you're group number 3, you have to move. It's inevitable. You're just having heartburn at these interest rates. So I want to remind you, we're going to put back up on the screen. I want to remind you about these payments. Okay. So if there was a 2% drop in the interest rate, that's $600 a month. So to put that in half, let's say your payment goes down. Let's say your interest rate goes down 1%. Let's say you're at 7% right now and you go down to 6%. That's a $300 savings on a $450,000 loan. This is real money, y'all. This is real money that you're going to be able to save. Make sure you finance with a lender right now like me that is going to give you this refi certificate to lower your costs. So it might only cost you a few thousand to refi. You can roll that in. Did you know that on a refinance, you could, if you wanted to, roll the cost of the refinance in on top of the loan that we're paying off? Okay, like the payoff is $300,000, let's say. The closing costs are $3,000. We would just finance $303,000. You could do that, or you could pay it out of pocket. Not a problem. Okay. So this group 3 camp that has to move, there are solutions for your payment. You could possibly ask the seller to fund a temporary buy down to get your payments lower. Or you could just suck it up and be like, okay, we've got a lot of clients right now that are getting second jobs to pay for things. I hear you. I get it. It's not ideal. They're working in restaurants, they're driving Uber, they're doing Uber Eats, they're doing DoorDash. I get it because the affordability right now is just crazy. In fact, I'm putting some numbers on here. On the board is we've got affordability at an all-time low. Like if you look at this graph, I'm just showing a picture graph, and affordability index is here. Now, back when the rates were so low, we had really high affordability and we were above the average. But now we're like way, way below. Affordability is tighter and lower than it's ever been, which is bad. It means less people can get into houses. Okay. So I want to hear y'all's comments. Please let me know. I'm kind of checking out Instagram. I'm checking the other stream. We want to hear your questions about if you're group 1, if you're group 2, group 3. Let me hear what you're thinking, because I'm here to answer it. I'm here live. It's Saturday. We're hanging out. Now, you're likely wondering, so I promised you this bonus round. So you're likely wondering, okay, Jen, whether I'm buying now or I'm buying later, my credit is not great. I've got higher balances than I'm used to. I've had to rack up credit. I just talked to someone the other day, and because of her divorce, she was left with a mountain of debt that is consuming her every single month. And her credit score is low because her percent balances are off. So I'm going to give you some power tips on credit, because credit, y'all, is the key to a lower interest rate. So whether it's now or whether it's a year from now and the rates are exactly where you want them, the credit score is one of the main driving factors, okay, of your interest rate, like big time. So you want to try to get in the 700s when at all possible. If you're doing a conventional loan, FHA loans is much more lenient. That's why FHA loans can be great. So those are the two main types of loans, FHA and conventional. You want to just try to be in the, you're always pretty golden if you're in the 700s, and more so if you're a conventional loan buyer, you want to be above 780. And believe it or not, a 720, a 740 goes in buckets of 20. So the interest rates for lenders are determined by categories of 20 points on the credit. So as you go down from 780, which is our best category up there, 760, 740, 720, as you go down, your rate goes up a little bit. Not a ginormous amount, but it goes up. Okay, so we want to get you above 780. Seasoning of credit, like the longer your accounts have been in existence. So try to keep things for a long duration. Like that 10-year credit card is doing you favors, even if, and you don't have to spend a ton, y'all. Just spend gas. Like that's it. You don't have to spend a ton of money. There's a lot of people that say, oh my God, I hate credit. I'm afraid of credit. It gets me in trouble. I hear you. But if you don't show the bureau, the algorithm is tweaked to know how responsible you are. If you're not doing any activity, there's nothing to score. So get a credit card. If you don't have a credit card now, you need to get one, and you need to stay under 30% of the limit. And so on a new credit card or credit cards that you have in existence, 30% is the magic number. So if your limit is $1,000, that's $300. Okay. And you can pay it off every month, pay it off when it's due. Your bill, you know, my Chase card comes out on the 9th. Like it's a weird date. Comes out on the 9th. Well, that's whatever the balance is on the 9th reporting, that's exactly what they report to the bureaus, is that. And then a couple weeks pass and my payment comes out of my account. I just auto debit it on the 6th. And then 3 days later, it cuts out again. And that's what they're reporting. So that's how the cycle works. Your balances are not updated live every time you spend money. That's not how the credit cards work. Okay, so power tip number 1 on credit is stay under 30% of the balances. Don't have more than 2 or 3 credit cards. That is the kiss of death to your credit. There is a rumor that's old that used to be true like 20 years ago, but it's not true anymore. Yes, you can close credit cards. That is, you want to close credit cards. Don't keep credit cards that are dormant that you don't use. Don't keep those open. It's not good for your credit score anymore. Okay, so 2 max is really ideal. So when I see people with 3, 4, 5, 6 credit cards, that's why their score is suffering, even if there's not a balance on it. Okay, if there is a balance on it, if you have 4 or 5 credit cards and there is a balance, your credit will be worse than if you have no balances on any of them. But open credit is exposing you to potential future charging up. And so try to keep 2, but keep the ones open that are the most seasoned, okay, that have the longest time on them, because seasoning is key. So the other thing, lates, you have to watch those lates, y'all. When you're fighting medical bills or fighting that late payment on your cable bill, etc., please don't let it go to collection. A collection, even if it's $20, will lower your score like 100 points. It's horrible and it's almost impossible. It's such a pain to get that stuff off. You will be really, really upset. We've seen credit scores. We've seen people with perfect credit in the high 700s, 800. I had a guy one time, I'll never forget, and he had savings. I mean, the money wasn't the problem. He could not buy the house because the month before, $100 collection somehow hit his credit and his score went down $100 to 100 points. Now he was buying a really big house. So that's what we call a jumbo loan, and credit is super, super strict in that. So for him, his credit was like 680 or something overnight because of $100 credit that he could have paid had he known, but he didn't know. He never got the memo. So watch the bills, watch your mail, watch your email, because sometimes everything goes in email. Okay, so pay stuff and dispute it later. Medical collections, this is a good shortcut. If you do have medical collections in existence, try to settle for like 20% of the balance or something, 50%, whatever, because there's a new rule since 2022. They have to delete them. So they will automatically be deleted from your credit, okay? So medical collections will automatically come off. Now, I do want to mention quickly on credit collections that are on your report now that are non-medical, just regular light bill or whatever. If you pay those to zero, they likely are not going to be deleted. The only way your score goes up is if they're deleted. So before you pay something and negotiate it to pay on collections, please try to negotiate and see if you can what we call pay for deletion. Now, I'm not a credit report. I don't help people officially with credit. I can just tell you from hundreds and hundreds and thousands of credit reports that I've pulled, what I've learned. And I'm giving you this free advice right here, right now for you on your credit. Deleting on your report as if it didn't exist is the key, okay? Deletion. Paying it to zero, it's going to stay on your report and just stay there. And it's the right thing to do if you owe the money. I'm not saying don't pay it. I'm just saying that it's not going to improve your credit score, which I don't agree with, okay? But I'm not the maker of these rules yet. When my kids are in college, I will go back to lobbying in Washington, and credit rights for you guys is the first thing I'm going to do. Don't worry. But as for right now, I can only convey to you and teach you what the rules are so that you know how to function and get the best interest rate when it's time to refi or purchase a house later on, okay? Okay, guys, we've been going a super long time. I really appreciate your attention today. So we're gonna hang on for a minute for any questions that y'all have. I hope you liked my bonus round of credit. I love credit. Again, I'm super passionate about it. When let's see, Diego's about to go to college. When Pablo goes in 4 years, I'm gonna be free as a bird to go back to Washington and lobby. I did it back in 01 and 02, and it was super fun. And now I can't wait to do it and really lobby for credit rights for those of you that just are strapped by these credit scores, that the system really needs to change. And so I'm here to tell you that I'm going to hopefully help and make some difference. But for right now, the best way that I can help you is by conveying to you what happens. So I've got a lot of longer videos. So I just do want to put a plug on my YouTube channel. Loan with Jen. I've got 600 videos. I've got a lot of them, about 20 videos about credit. So visit me there for some longer form videos about anything mortgage, real facts, no BS. I really appreciate y'all joining us today. Thank you. Thank you so much. Have a great Saturday. Over and out.